Stop trying to remortgage for a second, because right now you might be trapped in your mortgage and not even realize it. You can afford your monthly payments, you have never missed one, and yet you might not be allowed to switch. In this video, I'm going to show you why thousands of people here in the UK are stuck paying higher rates, even though cheaper deals exist, the exact rule that's stopping them, and what you can actually do about it before your fixed rate ends. Because if you get this wrong, you don't just overpay, you get stuck. Let's rewind. Back in 2021, money was cheap. You fixed your mortgage at 1.5 to maybe 2%. It felt like a smart, safe decision, right? Fast forward to today, rates are now closer to 5% or 6%, roughly speaking. So naturally you think, I'll just switch to a better deal. That's what people have always done. Except now it doesn't work like that. Because to switch lenders today, you have to pass an affordability test. And this is where things stop making sense, frankly speaking. The bank doesn't check if you can afford your current payment. They check if you could afford your mortgage if rates were even higher, sometimes 7% or even 8%. So think about this. You are currently paying £1,800 a month. You've been doing it without any issues. A new lender offers you a deal at £1,500, cheaper, safer, and you get rejected. Not because you have missed payments, not because you are in trouble, but because on paper, in a worst case scenario, you might struggle. So you are forced to stay where you are, paying more. That's not a glitch in the system. That is the system now. And that's what I mean by the modern mortgage prison. You are not stuck because you have failed. You are stuck because the rules have changed around you. There are three main ways people end up in this sort of situation. First, your loan to value. House prices are no longer rising the way they used to do. In some areas, they have even fallen. Even a small drop can push your loan to value into a worse bracket. And once that happens, the best deals automatically disappear. Nothing about your life has changed, but your options have. Second, your income. You might be earning more than you were in 2021, but everything else costs more. So when the bank runs the number, your disposable income looks tighter. Even if your situation feels stable, you appear to them riskier. Third, your own lender. If your bank knows you can't easily leave, they know something more important. You are not negotiating freely. You are choosing within limits. So they offer you a product transfer. It's not the best deal in the market though. It's the best deal available to you. And that's a very different thing. Now step back for a second, because this isn't just a mortgage problem. I think it's a system problem. In the UK, we have spent decades believing that markets should be left alone, that individuals should take responsibility, that less intervention leads to better outcomes. In theory, this sounds reasonable, this sounds sensible, but in practice, I think it creates fragility. Because what you have built is a system where individuals carry risks that used to be shared. And here is the key point. This doesn't happen in the same way in other countries. In the United States, for instance, many mortgages are fixed for 15 to 30 years. In France, people often fix for the full term of the mortgage, 20 or even 25 years. Germany has similar structures. So the system absorbs the volatility. In the UK, it does not. We have built a short-term mortgage market that pushes risk back onto the individual. So when rates rise, the system doesn't stabilize you. It sort of exposes you. And that's why this feels so brutal. Because it's not just bad luck. It is sort of structural. So what can you actually do about it? First, check your loan to value immediately. Not when your deal ends, right now. Because even a small shift can move you into a better bracket and unlock better rates. Second, understand your options. If you can't pass the affordability test, switching lenders may not be realistic for you. In that case, a product transfer becomes your most reliable route. It may not be the cheapest deal in the market though, but it avoids a full affordability reassessment, and that matters enormously. Third, timing. If your deal ends in the next 6 to 12 months, don't wait. Start early, because the closer you get to your lender's standard variable rate, the fewer options you have. Time is one of the only levers you control. And finally, mindset. The biggest mistake people make is thinking, if I can afford it, I'll be fine. That's no longer how the system works, actually. Now it's about whether the model believes you could survive something worse. So that's the real shift. And if you don't understand it, you are at a disadvantage. So here's the bottom line. You are not being trapped because you've been irresponsible. You are being trapped because the system has changed around you. And most people haven't even caught up with it yet. So the real question isn't whether you can afford your mortgage. It's whether you are allowed to leave it. If this video has helped you better understand what's really going on in the UK mortgage market, consider subscribing. And I'll see you in the next video. All the best.